Hello everyone, welcome to a series of short videos focusing on banking and finance and on the practical issues that treasury managers and other finance professionals may encounter in practice. This block of videos is devoted to credit agreements, and in this video we will take a look at general considerations that need to be made before you start the financing process. This video is brought to you by Elvyn Capital, your corporate finance advisor. So without further ado, let's get to it. For the purpose of making this video straightforward and for it not to be overwhelmed by too many scenarios, we have decided to make the following assumptions. Firstly, we have assumed that you have already decided to finance the project or the asset that is being financed by debt, meaning that it is not being financed by equity. Secondly, we have assumed that the debt is external, meaning that it is being provided by a bank or another unrelated party to the borrower, and it is not being provided by the shareholders, the sponsor, or any other affiliate of the borrower. And lastly, we have assumed that you've made a decision that credit facility is the best form under which the financing will be obtained, meaning in essence that you have not decided to choose bonds or other type of debt securities as the financing form. In future videos, we will dismantle these assumptions and take a look at why and in what situations you might want to take a different path than the one that is assumed for the purposes of this video. Decision to go for a credit facility means that your project, or as the case may be the whole business, gets a new stakeholder, the lender, whose interests and potential actions need to be taken into consideration. Banks and other professional financiers often have different perception of risk, and their view on upsides and pitfalls of the project that is about to be financed may, in some cases, substantially differ from the views that you are holding. By lending money, financiers will get exposed to various risks. That's why they will often require imposition of covenants, such as dividend payment or other upstream payment restrictions, imposition of control mechanism, such as requesting compliance with predefined financial ratios, or periodical reporting. For all these reasons, you need to take into account not only the risks specifically attributable to the financing itself, such as interest rate risk or potentially the foreign exchange risk, but you may need to go back to your analysis of the project and look at its ups and downs from the perspective of the lender, or in short, on its bankability. When analyzing the cash flows generated by the project, special attention should be paid to the fact that in most cases the cash flows generated by the project will be used to service the debt that is used to finance it, meaning that these cash flows will be used for repayments of the loan and also for payments of the interest accruing on the loan. Projects that will generate enough cash flows to service their debt right from the start will have substantially different repayment profiles than projects that will require a considerable period of time before they are able to make repayments or even to serve interest accruing on the loan. What is equally important is the cost side of things, which does not only determine the overall amount of the loan, but also the dynamics of the drawdowns. In some cases, these cash flows are easy to predict, like in the case of refinancing or acquisition finance. In some cases, especially in real estate development or project finance, when payments are made based on the actual progress of the project, this can be a little more challenging and require more attention. And special care needs to be taken in case of purchase price adjustment, the treatment of retentions, and the overall settlement mechanics in case of acquisition finance. What quite often is discussed too late in the course of a transaction is the ability of the borrower to use the money provided by the lender to finance soft costs, meaning the payments to professional advisors and other incidental costs incurred in the course of the project. Another important consideration to make is what collateral the borrower is able and is willing to provide to the lenders. If collateral or a guarantee is to be provided by a third party, this is, for instance, sometimes the case in relation to the vendor In acquisition finance, they need to be consulted well in advance. Why would you want to make these considerations at the very beginning of the financing process rather than on a decide-as-you-go basis? Changing a commercial or legal parameter later in the transaction will almost always have negative implications for the borrower. One of the most important implications is time delay. This time delay usually results from the lenders being forced to update their credit approval and legal and other professional advisors needing reasonable time to reflect the changes in the transaction structuring and documentation. These negative time implications can be especially unsettling in time stress scenarios like acquisition finance, bridge loans, refinancings, or derivative unwindings. In all of these situations, the borrower risks that some or all of the lenders will not obtain updated credit approval or will only obtain such updated credit approval under more onerous conditions, such as requests for additional corporate or personal guarantees, additional collateral, dividend restrictions, limiting the amount of the money provided, or requesting additional legal opinions or other assurance of professional advisors working on the transaction. In case of acquisition financing or project supplier auctions, the borrower also risks being dropped from the auction process. And last but not least, the borrower may be obliged to pay additional fees to legal and other professional advisors working at both sides of the table. The financing process can be demanding and time-consuming. Elvyn Capital Debt Advisory Services are here to help you to structure and manage the whole process professionally, comfortably, without drawbacks and delays, and to help you to obtain the best pricing and other financing terms that will allow your business to prosper.